Ever saved a few thousands on taxes only to realize it cost you tens of thousands later? Hi, I'm Moise Piram with Asset Management Group, and today I'm breaking down the most common tax moves that look smart in April but quietly wreck your wealth over time and what to do instead. Before we jump in, if you're serious about building real, durable wealth, hit like, subscribe, and share this with a friend or business partner who hates overpaying the IRS. New episodes every week with practical, high-income strategies that hold up under audit and actually compound your net worth. Let's kill the myth, dodge the financial disasters, and make smarter tax decisions today. So mistake number one, don't let taxes lead the strategy. Don't make a financial commitment primarily for a deduction or credit. As an example, allocating $100,000 just to capture an estimated $30,000 in tax reduction can expose your full principal to loss and may not fit your risk, liquidity, or return needs. Lead your investment policy and wealth plan such as required return, risk tolerance, time horizon, liquidity, and diversification. Underwrite the base case, pre-perk economics first, then assess the after-tax impact. Treat tax features as a tiebreaker, not the driver. Tax benefits can enhance outcomes in suitable deals, but they shouldn't be the reason the deal exists. Mistake number two, treating deductions like discounts. A deduction reduces taxable income, not taxes dollar for dollar. So as an example, at a 24% marginal tax rate, a $10,000 deductible expense lowers taxes by $2,400. So you spend $10,000 purely for the write-off, and you're still out of $7,600 in cash. So there's a difference between credits and deductions. Credits reduce tax dollar for dollar. Deductions are worth rate times the amount. Unnecessary spending to get a write-off can cost more than any tax reduction. Mistake number three, using vehicle write-offs to justify a car you don't need. Incentives such as bonus depreciation, Section 179, help only if a business use and eligibility tests are met. They don't convert a non-essential purchase into a good one. As an example, you buy a $100,000 SUV at a 30% marginal tax rate, and if fully eligible, your tax reduction could be up to $37,000, but you still spent $63,000 plus insurance, financing, maintenance, and face potential limits and recapture if the business use drops. You also have to do proper documentation such as mileage logs, and the awareness of total cost of ownerships are critical. Tax treatments can change with usage. Mistake number four, chasing tax deductions with high-risk deals. Be very cautious of high-risk investments that promise large tax deductions or tax-free income. Some examples may include oil and gas partnerships or real estate syndications. These risks include lack of control, liquidity issues, and potential loss. Many such investments are often poorly managed or audited by the IRS. Mistake number five, don't force real estate into your plan. Real estate can provide depreciation and other benefits, but is operationally intensive, such as having tenant issues or needing to come up with costs for repairs, financing, reserves, and regulatory compliance. If you dislike or can't commit to active management, the burden can outweigh any tax advantage. Be aware of passive activity rules. One such is without sufficient participation, which is you're not meeting real estate professional guidelines and material participation tests. Some of these losses may be suspended rather than currently usable. Cash needs, concentration risk, and interest rate cycles can materially impact results independent of taxes. Mistake number six, avoid tax-driven policy purchases. Policies like whole life, IULs, or VULs can include fees, charges, and surrender periods. Early year premiums often go essentially to costs, leaving limited early cash value. Loans and withdrawals and policy changes can trigger taxable events. There's also crediting rates and market performance risk, and insurers' dividends, if any, are not guaranteed. Projections are not promised. Use life insurance primarily for protection needs. Treat any tax features as secondary to suitability, affordability, and long-term policy management. Mistake number seven, funding strategies you can't explain. Avoid complex schemes or trusts promising tax benefits you can't explain. Red flags include schemes that are audited or disallowed by the IRS, so be very careful before you start any of these type of investments. Mistake number 8, having weak documentation. The IRS can disallow otherwise legitimate deductions if records are missing or incomplete. Keep accurate receipts and invoices, bank and credit card statements, contracts, and where applicable, mileage logs and time and activity logs. Separate business and personal accounts and maintain organized digital files. Mistake number 9, waiting until the end of the year to do your tax plan. Many elections and actions must be completed by December 31st for the calendar year for the taxpayer, such as certain charitable gifts or compensation timing, or even entity or benefit decisions. Waiting until filing time limits your options, so be proactive throughout the year. Planning throughout the year can improve after-tax outcomes and cash flow visibility. Coordinate across cash flow, investment compensation, retirement plans, and estimated taxes before the year end. Finally, mistake number 10, losing focus on core wealth drivers. High taxes often correlate with high income. So focus on building income through business or investments. Implement tax strategies that support your wealth building goals. Work with a qualified CPA to tailor these strategies for your certain situation. All right, that's a wrap. I'm Moise Piram with Asset Management Group. Remember, effective tax planning aligns with your overall wealth strategy. No shortcuts, no gimmicks. Keep your core income engines front and center and use tax tactics as tools, not goals, and protect yourself with clean documentation and early planning. If this helped, like, subscribe, and share it with someone who's serious about building durable wealth. Drop your questions in the comments. I read them and may cover your questions in the next video. Thanks for watching. See you in the following video.